How the Federal Reserve controls inflation. Inflation is a scary word for many people. It means that the prices of goods and services are going up, and your money is worth less. But don't worry, there is a group of people who are in charge of keeping inflation under control: the Federal Reserve. The Federal Reserve, or the Fed for short, is the central bank of the United States. It has a dual mandate: to promote maximum employment and stable prices. To do this, it uses various tools, such as setting interest rates, buying and selling bonds, and regulating banks. One of the main ways that the Fed controls inflation is by adjusting the federal funds rate. This is the interest rate that banks charge each other for overnight loans. The Fed can raise or lower this rate to influence how much money is available in the economy. When there is more money, people can spend more, which can boost economic growth and create jobs. But it can also lead to higher inflation, as more money chases fewer goods. When there is less money, people can spend less, which can slow down economic growth and reduce jobs. But it can also lower inflation, as less money chases more goods. The Fed tries to find a balance between these two goals by targeting a certain level of inflation. The Fed's preferred measure of inflation is the Personal Consumption Expenditures (PCE) price index, which tracks the changes in prices of a basket of goods and services that consumers buy. The Fed aims for an annual inflation rate of 2%, which it considers consistent with healthy economic growth and stable prices. But how does the Fed know what the inflation rate is? Well, it doesn't. It has to estimate it based on various data sources, such as consumer surveys, producer prices, import prices, and wage growth. These data sources are not always accurate or timely, so the Fed has to make adjustments and projections based on its best judgment. Sometimes, the Fed gets it wrong. Sometimes, inflation is higher or lower than expected due to factors that are beyond the Fed's control, such as supply shocks, demand shocks, or changes in consumer expectations. When this happens, the Fed has to react quickly and adjust its policy accordingly. For example, in 2020 and 2021, the COVID-19 pandemic caused a massive disruption in the global economy. It reduced both supply and demand for many goods and services, creating shortages and surpluses in different sectors. It also prompted unprecedented fiscal and monetary stimulus from governments and central banks around the world, injecting trillions of dollars into the economy. As a result, inflation spiked to levels not seen in decades. The Fed responded by keeping interest rates near zero and buying large amounts of bonds to support the economy and financial markets. It also adopted a new framework for monetary policy, called Average Inflation Targeting (AIT). This means that the Fed will allow inflation to run above 2% for some time after periods of below-target inflation, to make up for lost ground and anchor long-term expectations. The Fed hopes that this strategy will help achieve its dual mandate and avoid deflationary traps or runaway inflation. However, some critics argue that the Fed is being too complacent or too aggressive with its policy stance. They worry that the Fed will either overheat the economy and cause inflation to spiral out of control or stifle the recovery and cause deflation to set in. So who is right? Well, only time will tell. The Fed's job is not easy, and it requires a lot of skill and luck to get it right. But one thing is certain: controlling inflation is not a joke.